Hi, my name is Norm Miller, and I'm going to talk about the four-quadrant model. I'm from the University of San Diego, Bernard Moore Center, and this discussion is meant to support lectures on this particular topic that are derived from a book by David Geltner and myself, along with Jim Clayton and Pete Eichholz. It's the third edition, chapter 2 that I'm referring to, but previous editions also cover the four-quadrant model. This model is important because it connects the space and the asset models. It connects the markets for real estate assets, that is, what we're willing to pay for real estate, independent of the market for the space itself. So let me go ahead and explain a little bit about how this works. So let's start with the upper quadrant. What you have in the upper quadrant on the right side here is quantity and rent. Now you could typically see an economic graph of supply and demand with price and stock. Here we have just the demand portion, and we're going to put the supply portion down here. I'll come back to that in a minute. So this demand curve slopes down because the higher the rent would be, or price, the less would be demanded. So you see that it slopes such that the higher the rent, the less demanded. Let's look at the next quadrant. Here we have the rent level, and here we have the price that somebody will pay in the market, the typical investor, for that given rent level. So the slope of this line here is the ratio between what the market will pay in price for a given level of rent. You can think of that as a price to rent ratio, but it is in fact the inverse of a cap rate. Of course, it's a cap rate on the total rent in this case, but you can think of it as reflecting cap rates and yields in the market. A cap rate in the market, of course, is a current yield calculation defined as the net operating income divided by price. But this slope right here is pretty important because it reflects how much a property is worth per dollar of rent. Now, if this slope would flatten out, that would mean that people are willing to pay a higher price for a given level of rent and accept lower yields. And that would raise the price in the market for an asset even at the same rent level. If, on the other hand, the yields would get steeper or higher and the slope would be more like this, what that would do would be pay less for a given level of rent, and that would lower the price or value of those assets in the market. So here we have the space market on the demand side. Here we have the asset market. And then let's go down to the lower quadrant on the left. This is a kink supply curve right here. It's fixed in the short run, and then it's fairly elastic. That is, at a given price you will see more construction, so long as the price of that particular type of property exceeds construction cost. So this point where the kink is the cost feasible value of the property, above which you'll see new construction, below which you'll see none. And here we have a adjustment to the stock as we add more supply in terms of adding supply and quantity, and technically we should have an adjustment there for units lost as well, but you can think of this line as being a net adjustment. All right, let's go ahead and say what happens if something changes in the market. What if the demand would increase? Then at the same rent level we would see more quantity demanded. Let's go ahead and do that. So demand increases because maybe population increased or jobs increased, increasing the population. But for whatever driver at that same rent level, you see that the quantity demanded is right here, a much higher Q or quantity level than we have before. Again, at this rent level, it hits the demand curve here, it hits the supply curve here, or the quantity line here, and so there's a much higher quantity demanded at that rent level than before. Let's go ahead and see what happens as we extend this. At the current level of quantity supplied, right there, where you see the dot red line go up, the rents are going to increase, aren't they? And they're going to increase all the way up to that R1. Now note that before, the price that was supported was at this rent level and this price. Now it's much higher. Let's continue to take it down. That P1 level is way above the kink, way above cost feasible construction. Of course, this is an exaggerated curve, but you see that it hits the construction rate way out there. Everybody's going to try to add supply as quick as they can and try to add net new supply. And you can see that this doesn't really look like an equilibrium because it doesn't really match up as a square where all the markets are connected. It is possible, of course, for the market to overshoot and go through cycles, and we see that all the time. But let's go ahead and assume that that the market doesn't overshoot. Then it anticipates who's going to add supply and does not overshoot. What would equilibrium look like? Something a little bit more like this. Demand increases, forcing rents up at first, reducing vacancy down to 0 perhaps, and the value of the properties initially go up to this higher level R1. The prices are up at that level, but as we add new supply and the market sees it coming, it reduces the value of the properties a little bit, and we end up getting this rectangle or square that connects all the markets in equilibrium. And the point is this: the market's always working towards and trying to move towards equilibrium, even though sometimes it may undershoot or overshoot. Also keep in mind there's a normal level of vacancy in the market at all the time, and that should be expected. What happens if we change the slope in the asset market? That is what somebody's willing to pay for $1 of rent. So here we change the yield from 11%, I know that's high by today's standards, but the graph still works, to something lower, 8%. The slope moves down. The value of the property, which would have been right here, now moves all the way out to here. The price of the property is now much higher. You can see the new supply will be induced from this level to this level, and we're going to see quantity move from here all the way out to there. So here's the point. Even if rents don't change, vacancy doesn't change. If the yields required in the market are reduced, you're going to induce new supply. I hope that makes sense. Let me reverse it. If the yields required went the other way and were higher, the prices would go down below cost feasible construction and you would get no new supply. So this can work in both directions. That is, we may be at cost feasible prices right now, but if yields would go down, it would increase the value of the assets and you could get new supply. And if yields required would go up, it would shut off new supply. So there's an asset market connection to the amount of supply that's independent of the vacancy rate and the particular demand and supply that we see in the space market. That is, the space market could have a given vacancy, even 15%, but if the yields are going down enough, you might even see new construction in a market that may have what might seem to be abnormally high vacancy. But because yields go down enough, you could still see new supply induced. Again, the point is that the asset market valuation is related to, but somewhat independent of, the space market. It's related to it in terms of risk, but in terms of yield, that's really dependent on the other alternatives in the capital market and the appetite for real estate. And I'd like to thank you for your time. I hope that makes sense, and hope this helps for those of you that need review.